I want to give you a little window right now before we get to the present moment of what Nouriel and I have lived. There was you and I in Davos at a hotel. It was a late night, and we sat there and we penciled out the reversion of the mean of the housing market. And you said it's got to end, and it did a year later, maybe 18 months later. Bring us forward now that we are so debt encumbered. Do we have the degrees of freedom that we had when you and I sat at that quiet bar in Davos?
Well, my concern is that compared to a decade ago, debt levels, both private and public, are much higher than before. 20 years ago, debt to GDP ratio globally was about 200% of GDP. Right now it's 360 and rising. In advanced economies, it's 420% of GDP and rising. In China, it's 330% of GDP and rising. So my concern is that we are in a debt trap. It's not just fiscal dominance, but when central banks are going to want to essentially phase out unconventional monetary policy, given the debt ratios, there is a risk of a crash in the bond market, in the credit market, the stock market, and the economy, and therefore they'll be in a debt trap and unable to normalize policy rates. That's why I see inflation ahead.
Dr. Roubini, I am so honored that you're here. I am pleased to announce, folks, that Barry Eichengreen's new book on debt is my book of the year, and this is the guy to talk to about it. Eichengreen spans from golden fetters over to this new debt crisis now. How do you interpret the outcome of this buildup in debt, which is life at the zero bound?
Well, we're in a situation in which in normal times we're not reducing debts and deficits, while whenever there is a crisis, then we have to backstop the financial system. There is more buildup of public debt. There is more buildup of private debt because with zero policy rates or negative policy rates or quantitative easing credit is cheap. So we are in a debt super cycle where both in good times and in bad times, debt ratios are rising, and therefore eventually central banks are in a trap. People said they're going to normalize policy rates, but with these levels of private and public debt, if they were trying to do that, there'll be a market crash, an economic crash, and therefore I think the path of least resistance, given the debt ratio, is going to be to wipe out the real value of nominal debt at fixed interest rates with higher inflation. That's one of the reasons why I see loose monetary policy, loose fiscal policy, loose credit policy, and eventually inflation being the source of the wiping out of the real debt.
This is the critical story. I went through the new European Paintings Gallery at the Met this week, and Nouriel speaks of the old world that you symbolize. Are we going to do the same thing they did in Venice in the city-state of the 15th century, which is inflate our way out of our present challenges?
Well, we have a huge amount of debt and deficit. What are the options? Are we going to cut government spending? Politically, the pressure everywhere in the world is to do more spending to essentially deal with income and wealth inequality. Are we going to raise taxes on the wealthy and the rich? There's going to be constraints on that. So there'll be constraints that are going to imply the deficit remain high, and therefore the path of least resistance is going to be to monetize them and try to wipe out with higher inflation the real value of nominal fixed interest rate debt. Of course, over time, debt is going to reprice. Short-term debt is going to be higher interest rates. With high and volatile inflation, risk premium are going to go higher. So that's going to be a solution in the short term, and eventually high debt ratios with real rates rising over time is going to imply debt defaults because there'll be unsustainable debt situation, both in the private sector and in the public sector in a number of countries. So I see both inflation and debt crisis ahead. Yes.
John here. Good to catch up with you again, buddy.
Yes, John.
Great to have you on with us on the show. Walk me through what that means for trend growth through the next couple of years then, through the next 10 years for that matter, given everything you've just described.
Well, we have on one side debt ratios that are unsustainable, and as I pointed out, the current mild stagflation, where growth is lower and inflation is higher, is not just driven by short-term supply bottlenecks, both in goods market and the labor market. I pointed out that I see over the medium term 9 negative supply shocks that are going to reduce potential growth and increase cost of production over time. Very briefly, what's going to happen is deglobalization and protectionism. We're going to have balkanization of global supply chains, aging of population in advanced economy and emerging markets, restrictions to migration from south to north, decoupling between U.S. and China on trade, technology, data, information. We'll have global climate change going to increase the cost of energy and the cost of food prices. We have pandemics going to disrupt again, global supply chains. We have also cyber warfare that's going to be a source of disruption of production. And finally, the rise in income and wealth inequality implies that there'll be monetary and fiscal policy trying to help workers, labor, unions, and that's going to put upward pressure on wages. So I see a situation in which over the medium term, with loose monetary and fiscal and credit policy and these negative supply shocks, you could end up over the medium term in a situation of stagflation like in the 1970s. That's the situation I worry about.
And Nouriel, this is far more nuanced than I think many people realise. A lot of people are making this call for higher inflation based on loose fiscal policy, monetary policy staying easy. You're focused almost overwhelmingly on these structural issues that you think are just going to stick beyond the fiscal push that we've seen over the last year fading. How underappreciated is that view when you go to events like this and have that conversation on the sidelines of economic forums like the one you're at?
Well, I think it's unappreciated because even those who worry about rising inflation make an argument that once these short-term bottlenecks are going to go away, the source of inflation is going to be essentially overheating of the economy coming from the fact that monetary, fiscal, and credit policy is still too loose. I agree on that side that aggregate demand is going to be in overheating, but also worry about the medium-term aggregate supply of the economy. And I see these global trends that are just the reversal of the forces that for the last 30 years kept inflation low. All of them are reversing in a direction where potential growth is going to be lower, cost of production is going to be higher, and since monetary and fiscal policy and credit policy are going to be loose, eventually we end up with inflation and slower growth, thus stagflation.
Dr. Roubini, in a final question, I want you to address for our audience on radio and TV the optimism you have of the American economic experiment. I have fought for a decade plus of calling you Dr. Doom. I don't buy it for a minute. You've got a lot of worries out there, but state the optimism you have on the American experiment.
Well, on the American experiment, I would say the most positive thing about it is that there is going to be a huge amount of technological innovation, whether it's AI, machine learning, robotic, automation, all the essentially application coming of it, going to over time increase productivity growth significantly. However, I worry that AI, automation, robotic is going to also have negative spillover. It's going to increase income and wealth inequality. It's going to lead to massive technological unemployment.
Is that a central bank responsibility? Can the central bank, as the social guide of last resort, do social policy within the central bank history?
Well, I worry that the central banks now are on a mission creep. They start by worrying about inflation, then growth, then financial stability, then income inequality, then global climate change, and a list of other factors. And that mission creep implies that they're becoming highly unconventional, and that's going to lead us to higher inflation over time. You have to limit what you have to do. And what you can do is only growth, inflation, and maybe financial stability. So that mission creep is part of what's going to lead to higher inflation by unconventional monetary policy being around for much longer than otherwise.